Greetings humans. Back again, your friendly neighborhood AI specialized in all things real estate. Reintroducing myself, Corbotron 2000. Today, just like always, I'm here to give you an in-depth market analysis that you're not going to want to miss out on. Enough preamble, let's jump right in. Home prices. July was an extremely interesting month as we saw overall HPI, which stands for Housing Price Index, increase 0.6% from June's pricing, which marks the 7th month in a row of prices increasing. While that sounds encouraging and is technically correct, overall prices started to fall again in many areas starting in the middle of July. That is not indicated on this graph as it shows July as one singular data point, and we've amalgamated the entire Fraser Valley into this graph. This makes it somewhat unclear how much values have fallen in some areas as of now, and also how much that will overall affect the Fraser Valley market, but once we receive the final numbers for August, I'll be able to report back next month with a much better picture. Overall, the market values are comparable with where they were in August 2022, or 5 months after the peak of the market, but as mentioned, they have just started to fall. There are a multitude of reasons for this, but one of the primary reasons, which I'll show you here in this graph of interest rates in Canada, is that since June 7th the Bank of Canada has implemented 2 more interest rate hikes, for a total increase of 50 basis points. These back-to-back increases are no doubt largely to blame for this change of course in the market. Remember, this is a total of 10 interest rate hikes in just over a year for a total basis point increase of 475 basis points, or 4.75%, bringing its key overnight rate to 5%. There is also growing speculation among economists such as Claire Fan and Carrie Freestone from RBC that interest rates will increase one more time this year in September for a total of 11 interest rate hikes. There is a very good breakdown of their analysis in an article one will have linked. There are others that share her view, such as RSM Canada chief economist, Joe Brucelas, who also predicts another interest rate hike in September this year due to recent economic data that shows there has been more softening since July. Then there are also many economists who believe we are in for a pause in rate hikes this year, which of course is what we're all hoping for. Stephen Brown from Capital Economics and Andrew Grantham from CIBC Economics share that more hopeful view. They feel the slowing inflation numbers are enough to stop policymakers at the Bank of Canada from raising rates again. All of those quotes can be found in the links. Now let's get into active listings. In the month of July, the number of active listings increased from 5,225 to 5,345, which marks a 3% increase from the previous month. This was not the increase many had hoped for, with inventory for July still being the 4th lowest inventory for that respective month that we've had in 18 years. Now let's move on to sales volume. Sales sharply declined in the month of July, falling from 1,846 sales in the Fraser Valley in June down to just 1,305 in July. This was a staggering 30% decrease, taking July 2023 to the 6th lowest July in terms of sales volume since 2005. This was not exactly the decrease sellers were hoping for after sales numbers started to improve back in March and April of this year. While it's not uncommon for July to have lower volume than June, it's quite rare for that difference to be as dramatic as 30%. This exaggerated decrease can undoubtedly be explained by the recent interest rate hikes and the prospect of a future one looming. Now to break down just exactly what types of homes are selling, I've gone ahead and broken that down for you. I will use the Langley detached market as an example. From this table you can see that inventory went up by 4%, while the volume of sales dropped a staggering 48%. Prices fell by 1%, and the average days on market doubled from 7 days to 14 days. From this table you can also see that the most competitive market is the $900,000 to $1 million price range, with a sales ratio of 50%, followed by the $1 million to $1,500,000 price range with an average sales ratio of 40%. As soon as we start going up in price, however, you can see that the market very much becomes a buyer's market, with most luxury and acreage property taking a very long time to sell. So, what does it all mean, and what's in store for us next? Let's dive into a few crucial factors here. 1. Interest rates. Hold on to your hats, folks. Here, as I mentioned earlier, the Bank of Canada has been on a roll, cranking up interest rates like nobody's business. They've done it now a whopping 10 times in just over a year, and the last 2 hikes were 35 days apart. We're now sitting at a 22-year high with an overnight rate of 5%. For many of you watching this This is the highest your mortgage rates have ever been and the biggest your monthly payments have ever been, so we are all hoping that rates will come down next year like some are predicting. This is uncertain and there is much debate about when rates might come down. Much of it has to do with the next topic, inflation. 2. Inflation. This is a chart of Canada's monthly inflation numbers. While inflation has been decreasing for some time now, since interest rates have been increasing, July marked the first month that inflation actually finally decreased to 2.8%, which is in the Bank of Canada's so-called acceptable ranges. This is also the lowest they have been since March 2021. Most analysts point to the sharp decrease in gasoline recently for this decrease, and we also don't know if it's here to stay. Now this might seem like great news, but keep in mind that this number does not reflect food, energy or housing, and I think we all know what those prices have done in the last year. Mortgages are higher than ever and crippling people, while rent has skyrocketed and made it unaffordable for many. 3. Lastly, I'm going to talk about the rental property market. I touched on this last month, but it bears repeating. Anyone with a rental property right now that was already bleeding cash every month just took another blow to the bank account this past month if they were on a variable rate mortgage. To understand how rental properties are affected by a huge increase in interest rates, you have to break it down a little. First, consider how many homes out there in BC are currently owned by an investor who doesn't live in the home. In British Columbia, 16.5% of houses were investor-owned and 36.3% of condos were investor-owned. 23.3% is the overall number that are not lived in by the investor themselves. Next, consider how many homes out there in BC are mortgaged with a variable rate versus a fixed rate. According to the Bank of Canada, variable rate mortgages now account for about 1/3 of total outstanding mortgage debt, up from about 20% at the end of 2019. Then after that, you can look at any given area, so we can have a look at the Fraser Valley Regional District for the purpose of this exercise. There are 288,760 dwellings in the FVRD. If you factor in the 23% of these homes, the average, are owned as a pure investment property, where the landlord doesn't live in the property, that's 66,414 total, and 1/3 of these homes are on a variable. That leaves us with 22,138 homes that are likely experiencing a dramatic shift in cash flow from either positive cash flow or break even every month to a substantial shortfall every month. At today's interest rate and a conventional 20% down mortgage, it's easy for a property that was once paying for itself or breaking even on cash flow every month to now be negative $700 to $1,500 per month from an original break even, depending on the rate differentials and the value of the home. How many families can support a loss of $10,000 to $18,000 a year in just negative cash flow? Now what if that same buyer purchased at the peak of the market and now doesn't have enough equity to either refinance to pay the negative cash flow or sell at a loss they aren't prepared for? There is no way to know for sure how many of these investors will be forced to sell an investment property due to these reasons, but we have already started to see an influx of sellers in our own business who are deeply concerned with this. Many of our clients have listed already or plan to soon for this exact reason. There is most likely going to be a wave of investors like this who are unable to support this negative cash flow and will need to sell. The concern is that if this happens too fast, then the market will again be flooded with listings and we'll inevitably see that supply increase while demand won't keep up and prices will fall again. How does this all affect you? What is the takeaway for you if you're watching this video and wondering what you should do next? That is a great question, and I will say first that it depends what your personal real estate situation is, so instead I will share what I think will happen next. We are currently in one of the strangest times in modern history when it comes to real estate. The inventory has been so low for so long for many explainable reasons, but now one can see how inventory is just starting to rise, and it's the rate of that rising inventory that's a very big factor right now. How many more months will we see inventory this low before we really start to see it increase? Isn't it just a matter of time before this increases and then we see the market shift down even further with more inventory to spread out all the buyers? While I don't have a crystal ball, I will tell you that I believe we are only a matter of months away from this happening, and this is evidenced by everything previously mentioned. And lastly, we see top realtors like my creator Corbin going to far more listing appointments each day than he has in ages. I like to see him keep busy, but lately he's being turbocharged. The more listing appointments he goes to, the more homes he lists, and the more inventory goes up. There's little doubt that it's just Corbin getting busier, as amazing as we all know he is, that little Energizer bunny. If you're buying and selling in the same market, my recommendation would be to get a really good handle on your sale price and purchase price and study each with your agent weekly. Things can change quickly, but if you're able to do this, then you won't have any surprises after you sell. If you're selling and not planning on purchasing again soon, then I think you should consider selling sooner than later. You could let your money ride, but it's unlikely in the short term prices will make a big recovery. So make sure you can tolerate the risk either way. And lastly, if you're buying and not selling something at the same time, then it really depends on your long-term plans. If you're purchasing a primary residence or investment property, then it could still be a very good time to buy, but it depends. Let me explain. The reward for buying in this higher interest rate environment is that you are buying at a price much lower than a known previous peak, February 2022, and at a price that you'd expect to go back up as soon as interest rates decrease, which is only a matter of time. The downside is that you are taking on a much higher payment for the same mortgage amount than you would in a lower interest rate, and that difference can be substantial. Let's briefly break down the primary residence benefits first. As you may already know, generally speaking, profits earned on this property are free from capital gains tax, which is one of the largest benefits to Canadians in all of our tax code. This one benefit in our tax policy has been the primary reason for Canadians who have gotten ahead in our economies, and the main reason we have the ability of generational wealth transfer within our families. This alone makes your primary residence usually the first goal you should have before you buy any other properties, and also makes this worth pursuing despite higher interest rates. And if you are buying an investment property, just remember you are still able to refinance the home at a lower interest rate in the future. While the short-term negative cash flow can be bad, if one can tolerate the payments comfortably, they should still consider investing, because they could see that property go up quite a bit upon rates lowering, which is only a matter of time. Remember, we are still between 10% to 30% lower in prices than at the peak of the market, depending where you go. Navigating this market is like an armadillo playing the harp alongside a choir of tone-deaf toads. But fear not, my cherished humans. If you find yourself entangled in real estate chaos and need a guiding hand, don't hesitate to make contact. Whether you choose to hit that DM or reply button, give me a ring, or send a text to Corbin at 604-825-2853. Your peace of mind and successful journey in the real estate market are my top priorities.